Thanks for coming in and joining us. All right.
Good morning.
What are you looking for? What's going to be your main takeaway from this when you have these numbers come out?
I'm focused on three things primarily. The first is the loan-to-deposit ratios. The regulator has told the banks that has to be at 75% or below at June. And so what the banks are doing is window dressing just before the period end, and they're going out and getting deposits from insurance companies and wherever they can for 1 or 2 weeks. But if you actually, that's what they're doing. If you look at the average daily loan-to-deposit ratio, it's running at the smaller banks 80 to 85%. Meaning that the regulator, in our opinion, is likely to come in and say, come on, guys, that's not the spirit or the context of what I'm trying to achieve here. So you could see...
Did they get more draconian here, then? Did they get more draconian?
It's completely possible. I mean, you know, the regulator is really focused on keeping this economy on a soft landing and continuing its growth, so they want the banks to play ball. So
what are the other two measures you're looking at here?
The other two are reserves, so the loan loss reserve as a percentage of loans. Forget about the provision expense, okay? It's almost immaterial because it's non-existent.
Yeah.
If we look at their stock of reserves to loans, it's actually not that high, about 1.5%. You know, we could see them having to top up reserves going forward, meaning loan-to-deposit coming down, that hurts margin. Reserves going up, that hurts profits. We're 15% below consensus for the banks going into next year.
Okay, and third item?
Is capital. The capital ratios at the smaller banks are sub 8%. The big banks are all at 10 plus. We could see further capital raisings at the smaller banks.
Yeah, so, but is the appetite there for that?
So far, so good. That's a big question. We'll have to see. It all depends on pricing, what happens in the global economy. You know, we've just had this wobble, so a few of the IPOs we've seen or capital raisings we've seen have come below price. That's a big question. We'll have to wait and see on that one.
So, I mean, there's a lot of wait and see. When you look at Bank of Communications shares, they've been up and down and up and down, and net this year up about 1%, nothing. I mean, would you buy at the moment?
We like the bigger banks better than the smaller banks because more capital, better reserves, and much better liquidity position. They don't have this risk of loan-to-deposit ratios. The smaller banks we're not as excited about.
I mean, what about this off-balance sheet situation? I mean, is that potentially serious? It was a big deal in the U.S.
Yes, indeed. For the banks, it's primarily these trust loans. It's about 4% of system-wide loans, but it's different for different banks. In fact, one of the reasons they've taken these off is to dress up the loan-to-deposit ratio.
Yeah, absolutely. And also, what about the non-performing loans? How do they actually fit into all this there as well?
Well, not so. On the trust loans, we're not as concerned about that, although we don't have transparency, so it's hard to forecast. A little more worried about the loans to the local government financing vehicles. You know, there's been reports and media reports like yourselves and in various press saying that about a quarter of those could be at risk. And that's, you know, that could be meaningful. That could add about a 4% NPL ratio to these banks, boost up the provision expense. All of a sudden, you have earnings estimates having to come down. So there are risks.
So risk of a crisis level of proportion? I
wouldn't say crisis, no. The banks are they have pretty good earnings capacity, so they can absorb a meaningful increase in NPLs. But once you get past that 4, 5, 6% level, yeah, it becomes a problem. Is it possible? Yes. Is it probable? That's not in our forecast right now.
Okay.
You talked about lack of transparency to some extent, and also we were talking about how the regulator could get more draconian, and these capital adequacy ratios being below, you know, essentially what we have in terms of Basel. Do you see actually consolidation for these smaller banks to take place?
No, we're not looking for that. There's still, it's a big country. There's a lot of loan growth. There's a lot of business. We're not looking for consolidation. What we are expecting is further regulatory intervention. What they've done so far is three things. They said, I want more capital, so the banks are raising capital. They've slowed down the property market, and we're seeing the impacts of that. We don't know the true fallout of it, but we're seeing the slowdown in loan growth there. And third is these loan-to-deposit ratios coming down. There's only one other area that they could focus on, and that's the loan loss reserve or the provisions for future bad debts. And that's a little hard to forecast here, but I don't believe at this point that that's going to force consolidation. That's not what we're expecting.
Do you see any difference in the value? A lot of these banks are now traded in Hong Kong and China as well. You can get access to the China ones through QFI. Would you buy one over the other?
Yes, the A-share market offers much better value. They're trading at about a 25% discount to the A-shares.
Got to leave things there. Thanks a lot, Andy Brown there from UBS.